Knowing whether your business is making a profit or a loss can't be a guess. Many people think that just because they're selling well, everything is fine. But the reality is that many companies fail even with strong sales, simply because they don't control their numbers. And that's exactly where the income statement comes in. It's the report that helps you understand the financial health of your business. So, let's now explain in a simple, practical, and straightforward way what income statement is, how it works, why it's essential even for small businesses, and how you can start using it today. So, let's get started. Income statement. In practice, it's an accounting report that shows how much your company profited or lost over a specific period. It can be monthly, quarterly, or annually. It summarizes all the money that came in, revenue, all the money that went out, costs and expenses, and shows you in the end if you had a net profit or a loss. In other words, it's the accounting answer to the question every entrepreneur asks. After all, was there money left over at the end of the month? 2. Why is it so important? Because it's no use selling a lot if there's no money left over at the end of the month. And believe us, this happens more often than you think. Companies that don't use the often make serious mistakes, such as thinking they are profitable when they are just moving money around, growing without control and failing due to a lack of organization, making decisions based on gut feelings, mixing company money with personal money, among many others. With the income statement in hand, you and your business will be able to know exactly if you're making a profit or not, discover where you are overspending, make better decisions about investments, hires, and cuts, establish more credibility with banks, partners, or investors, and many other things related to your company's financial health. Therefore, if you want your business to grow healthily, the income statement is a mandatory and indispensable tool. 3. What does the income statement show? The income statement follows a logical and simple structure with these main items. Gross revenue. This is everything that came in from sales, without any deductions yet. Deductions. These are discounts, returns, and sales taxes. Net revenue. How much money came into your company's cash flow? Costs. Everything spent to produce or deliver the service to customers. Gross profit, which is the profit up to this point. Operating expenses. These are the costs your company incurs that are not directly involved in producing the product or service. Examples include rent, salaries, electricity, internet, marketing, etc. Operating profit, which is the profit up to this point. Non-operating expenses. These are expenses not directly linked to the company's main activity. In other words, they are not essential costs for generating revenue. These are expenses that don't fit into the production or sales process of the company's products or services, and include items like losses on investments, fines, and interest on debts. Net profit, the final profit. This last number, net profit, is what matters. It's what tells you if the company is in the black or the red. Imagine a company that sells clothes online. In a given month, the summary was as follows. Gross revenue, 25,000 US dollars. Discounts and returns, 1,000 US dollars. Net revenue, $24,000. Costs, clothing purchases and shipping, $10,000. Gross profit, $14,000. Operating expenses, rent, employees, ads, $9,000. Operating profit, $5,000. Other expenses, bank interest, taxes, $1,500. Net profit, $3,500. So, even with $25,000 in sales, the real profit for the month was $3,500. If the managers of this company only looked at the sales value, they might think the company is doing very well. But in reality, the income statement shows the truth. The real net profit isn't as high as they imagined. And most importantly, it shows what adjustments may be necessary to improve the business's financial health. 4. But be careful. Income statement is different from cash flow in a very practical way. Income statement analyzes the profitability of the company. It shows if the business is financially viable, while cash flow shows the money in the company's cash register. In other words, it can pay its bills daily. To exemplify the difference, your business might even have a profit on the income statement, but not have cash on hand due to possible payment and collection terms on sales. Therefore, the two reports complement each other. It is essential to understand and work on your business's cash flow in conjunction with the income statement. And if you don't know what cash flow is or how to work on it in a way that works, watch this video that explains everything you need to know about this topic. 5. Who should create an income statement? Anyone who wants to have a real business needs an income statement. It doesn't matter if you are an individual micro-entrepreneur, have a small store, or provide a service. If you sell, invest, and want to have money left over, you need to work on and closely monitor your income statement. Moreover, if you plan to grow, have a partner, or seek financing, the income statement is one of the things that will be required to assess the financial health of your company. 6. How to create your company's income statement. You can set up your income statement very simply with a spreadsheet in Excel or by using online tools such as ERPs, which are management platforms that can greatly help your business. And regardless of where you develop your income statement, these are the steps you must follow. List all revenue that came in. Here you will sum up all the gross value that came in from your sales or services provided in the month. For example, did you sell $10,000 in cakes and sweets in the month? That's your gross revenue. But it's important to point out here that this is the full amount before any discounts, taxes, or fees. 2. Subtract discounts, taxes, and returns. Now, you need to subtract everything you had to pay from the gross revenue. This includes items such as commercial discounts are given to customers, sales taxes, product returns or service cancellations, among other similar items. For example, total discounts given to customers to make sales, $500. Taxes on sales, $1,200. Product returns made by customers, $300. Total to subtract from gross revenue, $2,000. So, net revenue equals gross revenue minus discounts, taxes, and returns, resulting in $8,000. Calculate the direct cost of products or services. Now see how much it costs your company to produce what it sells. This is called COGS, cost of goods sold, or COS, cost of services, depending on your type of business. By the way, if you want to understand more about COGS or COS, write cost of product and service in the comments. And if there are enough requests, we'll develop a video on this topic, okay? So, following this logic, include everything that is directly linked to production. Raw materials, packaging, direct labor, a confectioner or seamstress hired only for production, specific sales shipping, commissions are directly linked to the sale. Everything. For example, with the cake company we're talking about. So, your direct costs could be ingredients, $2,000, packaging, $300, total cost, $2,300. Thus, gross profit equals net revenue minus direct costs, resulting in $5,700. List your operating expenses, fixed and variable. In this step, you need to include all the day-to-day operating expenses, even if they are not directly linked to the production of the products. Fixed expenses are those that exist every month, even if you don't sell anything, such as rent, utilities, such as electricity, water, internet, salaries, accountant, monthly marketing, like the monthly fee for a professional or an advertising agency, and many other items. Variable expenses, on the other hand, change with the volume of sales. That is, additional packaging, sales fees, payment machines, marketplace fees, etc., bonuses, and commissions. In short, list all the expenses that vary as your sales happen. Returning to our example, rent, $1,200, utilities, electricity and water, $300, team member's salary, $2,000, online advertising, $500, totaling $4,000. Thus, operating profit equals gross profit minus operating expenses totaling $1,700. 5. Subtract interest, fines, or other non-operating expenses. Now, we add those expenses that are not part of your commercial routine but still affect your final result, such as loan interest, late payment fines, legal fees, lawsuits, accounting losses, expenses from the sale of equipment or property. In short, all possible expenses related to issues that are outside the day-to-day production and sales of your company. So, in our cake company example, loan interest, $200, late payment fine on a bill, $100, totaling $300. In this way, the profit before income tax, operating profit, non-operating expenses, reaching $1,400. 6. Evaluate the final profit. Finally, we arrive at the final result, profit or loss of $1,400 in profit. Therefore, we can say that this is the number that shows the true financial health of your business. Furthermore, if you want to develop the income statement in an even more professional way, the help of an accountant can be very useful here to provide even more security in your company's financial calculations. 7. But what if the income statement shows a loss? Well, first, if the income statement gives a positive result, that's good. But you need to analyze it to understand how it will be possible to increase your business's profit even more without losing quality. Now, if it shows a loss, on one hand, the income statement has already helped a lot by showing that your company is not in good financial health. Therefore, some adjustments will need to be made, such as reducing expenses, renegotiating costs, studying ways and the feasibility of increasing your prices, improving the profit margin, cutting waste, optimizing processes, among many other fronts to get back to having real profit. And this is precisely why the income statement is extremely important for all types of businesses. With it, you see the reality and act with planning and strategy in a professional and profitable way. Therefore, if you want to understand how to make your business have a true profit, watch this video that shows the best practices for a professional financial management for any type of business. And it's mandatory for your company. We hope you enjoyed it, and if you want to know more about how to set up and manage your own business, visit our YouTube channel where we have several videos about this subject. If you liked it, share this video with your friends and family to help them too. Thanks, and see you next time.